Good evening, everybody. Happy Sunday. It's March the 13th. We're about 6 p.m. in Toronto. I'm your wealth guy. Let's talk money. Let's talk Sunday market preview for the week, and there's a lot to talk about. So, first things first, let's talk about last week. So, what happened last week? Well, on Friday, the markets took a horrible turn to the red after being positive up as much as 350 points in the early morning and pre-market. Well, what turned the market? Well, there were a couple key trigger words here that the market absolutely did not like. Number one, Biden using the words bioweapons. Now, that is a trigger word, and I'm going to mention this. All throughout the week, the term bioweapon has been repeated over and over by different delegates and different members of the U.S. government. Now, that is concerning because not only did we see that, but NBC News reporting the term false flag attached to that, and that report was on March 9th. So as you can see, they've been talking about bioweapons and false flags as far back as early in the week. Now, for me, whether or not it's a false flag by the Russians, false flag by the Americans, something like what we saw in Syria with the false flags and the white helmets, the concern here is that no matter what we get, just using the term is enough to shake the markets. And that's what we saw. We saw a 500-point reversal in the markets before the US 30 finished 210 points in the red. Now, other news over the weekend that's potentially going to keep the markets suppressed this week. Iran decides to missile strike Iraq as a warning to the US and allies in the region. Now, what's that really going to do? Well, anytime you have a military or attack in the Middle East, you know oil is going to continue to spike. So I anticipate crude is going to continue its aggressive march upwards, not quite with the same vigor that we saw last week, but it's still going to march upwards. In fact, to be quite honest, it's going to be the trend for pretty well the entire year. Expect crude to continue to march upwards because that is the lifeblood of the military-industrial complex. So expect it to keep going up. Other news. About half an hour ago, the U.S. issued a warning to China that there would be consequences if they assist the Russians evade any kind of sanctions. What do you say to that? I mean, it is China. Never mind militarily, just economically and dependence on the Chinese to help continue to propel the U.S. economy forward. It's a very questionable game. In fact, I think it's going to be absolutely empty threats. And I think everybody knows that. I think the markets are going to realize that, and I don't think it's really going to be taken with any kind of seriousness tomorrow. But let's talk about next week now, because the volatility in the markets are going to absolutely continue. And in fact, we may even see a significant uptick in volatility this week. And why? We have the rate decision this week. So the Fed will be coming out discussing interest rates. Now, I'm anticipating a 25 basis points increase. Some traders out there are looking at 0.5%. I don't think they're going to go that aggressive. And the reason I say that is because the true action of the Fed is to really keep inflation going. It's in their interest. It's in their interest to be the buyers of last resort. Now, I do anticipate, again, that 25 basis points. And I think the markets are absolutely going to love it because the markets want to see, even if it's not truly going to do anything for inflation, and we know it's not, the market still wants to see that the Fed is looking to do something. And so if we get that 25 basis points or maybe even 50 basis points, expect the markets to react very well and fly to the upside. A no action is going to absolutely tank the market, and the market will not be happy. So expect that extreme level of volatility this week, especially surrounding the rates. Now, if we take a look a little bit further, let's see what's going on in the world, because the crises that we're starting to see not just on the level of energy. So we know that there's an energy crisis, but now we also know that there's a food crisis that started. And if we take a look at commodities will continue to go to the upside, just like crude. And I'm not just talking about metals, which we know will continue going to the upside at some point. For me, I'm actually talking about food-related commodities. So you can take a look at wheat in particular, which has absolutely skyrocketed. And even if we do take a look at industrial metals, never mind the precious, we're seeing nickel absolutely skyrocket. We're seeing copper absolutely skyrocket. So we are seeing a lot, and I mean a lot, of movement in commodities to the upside, even though this week we saw a little bit of a pullback. But I do want to also point out that this will eventually lead to continued inflation. As I mentioned, inflation is not going anywhere. It's certainly not transitory. I think we can all come to terms with that. But inflation will still continue to go out of control, eventually and truly eroding the value of the middle class. And that is the concern. Now, what's going to end up happening is there's going to be continued borrowing, and borrowing at the individual level, borrowing especially at the government level. And we can see that because as long as the war continues, the government will continue to pump money. In fact, they're using this as an excuse to continue, and I'm very specifically talking about the Fed here, continue to print money, buy everything, sell whatever they want. There is absolutely no intention to reduce inflation here. The major concern is that this is going to, again, going back to commodities, lead to an absolute commodity boom. And this commodity boom will continue to cripple the middle class. But what I really want to take a look at here, because I've mentioned money printing a number of times, is really the 10-year yield. That is what we need to keep an eye on. The 10-year yield is the health, or is an indication of the health of the debt system at the governmental level. So long as the 10-year yield remains relatively stable, you can anticipate that the markets will continue to move to the upside. And yes, there are hiccups like we have now, and yes, we may even have a significant pullback depending on what we see this week. The markets will recover and the markets will be bought up because the Fed is there and major institutions are there to pick up all the pieces after the panic selling. They always have. And in fact, that will probably lead to a very significant recovery within a matter of months from the day of a potential pullback. But watching that 10-year yield, there's two things I want you to really take a look at. Number one, we will be sitting at about 2%. It is what it is. We're almost there already. It's actually good for the banks. We'll turn them profitable if you are a financial holder. Whether it be stocks or mutual funds, ETFs, doesn't matter. It is going to be very beneficial for the banks. In fact, the banks want to see 2% plus. But the other thing you really want to look for, the big indicator as to what's going on in the market, would be repeated spikes to the upside in the 10-year yield. If we start to see 6, 7, 8% daily increases in the 10-year yield, that's when we know that the debt market is getting ready to collapse. And that is when you know the markets will pull back as well. You see, the collapse of the debt market will absolutely lead to the collapse of the equity market, because as cash flow leaves the debt market and we see that sudden spike, we know that money is not going into equities. It's going to go a lot into commodities, not even cryptocurrencies, because quite frankly, I think that cryptocurrencies at the time of collapse will also pull back quite significantly. Yes, you may have some bull moments, but I think for the most part, people will run scared. And in that event, we're going to see commodities spike to the upside, in particular safe havens like precious metals. But overall, commodities will be where the spike will happen after the 10-year yield and the debt market collapses. But that's it, everybody. It's a long video. I never really edit these. I like to just kind of go with what's on my mind, whatever notes I've taken, whatever I've seen over the last couple days, last week, and what I expect for this week. As I mentioned, it is going to be volatile, so be ready for that. Otherwise, we'll watch that Fed report. All right, everybody. I will see you tomorrow morning at the opening bell.